All right, good evening, guys. Weekend reports for June 17th, 2022. This is actually becoming the sniper trading workshop. So you guys are getting a deal. Give a hat tip to my brother. I just watched his promo video for the sniper trading. Really impressed and very proud of him. And much thanks to the guys who made such nice comments, especially Griff. I just thought it was very touching and genuine. And it's very humbling to know that what we're doing is helping. Makes us want to redouble our efforts, that's for sure. So I want to acknowledge Paul's work here. Made major strides. He's following the coaching. What do you know? Let go of the reins a little bit more. And so he went back over his exits on this last 3 weeks of charts. That's why you mark them up. That's why you take the game film. And what he found, if he'd set his initial stop at the far side of the dragon and then trailed with the PSAR, the results would be better and much less cognitive load and emotional fatigue. And then hat tip to Jack with another tweak, taking only the trades in the direction of the PSAR generated fewer trades, kept him out of some of the chop. And he's working on a rule in progress about not giving back too much on really good moves. So he's defining your really good move as that plus 1.5 R. So he wants to make sure he's keeping at least half of that. And so even with just 1 day in the workshop, in the shop, making bowls, felt much easier, like something it could work on and refine. So he's going to work on it for 50 trades and provide an update in 50 trades. That's how you do it. That is how you do it. So while we're here, let's just take a look at what he did today. PSAR flip, buys a 1, 2, 3. So that's a little bit slow. If he gets it right here, or at the PSAR flip, or even a little bit earlier with a stop down here, he probably scratches that trade. He takes the PSAR flip here, gave it a 1, 2, 3. Micro loss is about minus 1.1. Next PSAR flip, using the PSAR as the stop, it works for 1.24, which negates that. The all-important kata 2, up, pause, up, makes 3.13, and he just cashed some at the gift. Okay, but just raise your stop here and keep half. And then that resolves the problem of entering here or here or here. So each one of these is like a little mini kata 2. Especially you can see that in the RL10 and go. So he left another 3 to 4 on the table right there, but we'll take 3.2. Very relaxed, nicely done. This is the formation you got to look for right here. This little pause. Now you notice that this little price action here caused the RL10 to roll down a little bit and then reverse up. Well, why didn't it do that here? Why did the RL10 just keep going even though it was going sideways? Well, because the previous 10 bars were universally up. So you've got all of this price action here that's really, really strong. And so this sideways action doesn't even make the RL10 dip until it gets up into here, right? Now you've got 10 bars, and that's what makes it dip a little bit. And then you get that next upward impulse and it goes. So point being is that the first pause doesn't really cause the thing to dip. The second pause causes it to dip. But then when it doesn't fail and starts to resume, that RL10 gets quickly up again in a hurry. So that's where you start seeing things like this. And here, where those are some really nice entries. Nice work from Paul. So yesterday was this sell-off that closed, a slight gap down, ran down, ran up, closed back, and almost like a little doji action to close at 365. So slightly down for the day, but still a pretty small range day as part of the 5-day range, as part of the 10-day range. Look how big the 10-day range is with a high here and a low today. That's as big as the 30-day range. So this reinforces our notion that, which you see reflected in the daily report on when we're looking at the Z-score stats of the S&P, that a 10-day period, you can get all kinds of suffering, compared to the previous two 10-day ranges, which were just kind of normal in size. This thing was almost double that, and all of it in the wrong direction. This did not run away to the south. Of course, it didn't look like it was painful here as it was starting to get some bottoming action on the Fed day. That was the Fed day. But then the market reacted with that gap down, and so it's still suffering. So we are still in bullish normal conditions, not surprising. Slope of the river is down. Slope of the dragon is down. Here's the Z-1. We are outside of Z-2 between Z2 and Z3. This is really vulnerable. This is really abnormal. So from those abnormal conditions beyond Z2, you either get recovery or painful. It's rare for that to just drift sideways. So we're looking either big down or big up. You can see the PSAR flip right here. Down. Here's where it turned from summer to fall to winter, where it crossed Z1, where it crossed Z2, tested Z3, and still failing. Short-term momentum down. Still 23.67% below the swing high. Bearish territory. Okay. Got it. Understood. Looking at the sectors. The S&P right here, 0.22. Here's the boundary between, winning and losing for the day. The S&P was at 0.22. The worst index was the Dow today at minus 0.03, or 0.39%, I should say. Treasuries, 0.32. Emerging markets, 0.38. Russell, 0.78. Tech was the leader today, 1.22. So let's look at the ones that won today. Start with the sectors. Materials, lumber, blockchain, finance, 0.29. Real estate and tech, 0.92. Consumer discretionary, 1.09. Global future of finance and commercial real estate, 1.1. Mexico, 1.2. FANGs, 1.46. Had a little more strength than the Qs. Lithium batteries, 3.8. Both ARCs, 5%. Biotech and clean energy, 5.7. Individual targets now that were great. Bakkt, 8%. Robinhood, 4%. PayPal, Squarespace, so some of those financial disruptors. Tesla, the most important stock in the world, 1.7, closed at 650. Right, stuck in that trading range between 600 and 700. US Steel had a nice rebound, 1.6. Apple and Microsoft, the two tech bellwethers, conservative tech, were better than the S&P, and Cliff and Coinbase. So a pretty wide range of things to choose from. So S&P again at 0.22, the baseline. The other lumber and staples, 0.24, 0.36. Food, 0.6. Ethereum, Aussie dollar, Brazil, 1.24. Wheat and precious metals, Bitcoin, marijuana, large cap blended crypto, 2.17. VXX, 3%. Blended commodities, oil got smashed today. The whole oil sector, energy sector, just got murdered this week. Energy, 5.5. Oil exploration, 7.3. Devon Energy. Once again, notice that Devon Energy acts like a leveraged play on the broad energy and oil sector, down 8.3%. Wait till you see this trade. It's at 4.5 to 1 on the retest of the 10-day high. And again, the R10 is that standard intraday stop that we're using now, which is R10 is 1/10 of a range stat, which is defined as the max reasonable intraday move, mathematically speaking. Gets updated every day. This R10 column is proving to be really powerful, is very good. We got a lot of trades to go through today, so I'm going to hit the reports first, in case you want to just get it and go. Oh, dummy. Sorry. Didn't mean to do that. All right. As usual, start with the weekend report. bearish normal, massively oversold, a little bit of slowing down of the pain and suffering over the last 2 days. Critical state in here for the risk Z. Still 0% on the ETF2. That is such a good mechanism for intermediate time frames. It just, I can't love that thing too much. The monthly, from the peak, it has now passed through the Bollinger Band mean. This is on the monthly now, right? Monthly bars. There's your COVID sell-off. There was the Trump rebound. And now this is the Biden. Biden has lost all of that. And now we're into this crap. Not good. Next target, fair value down here. The 9-day, which is really 2 weeks, just shows how painful that sell-off has been. It's the 23% from this top, from this peak up here, and well below that, and pushing Z3 to the downside. That is not good at all. But that's what I want you to notice, how bad things can get in 10 days. The weekly highlights that especially well. 10 days ago, this thing was, we had come out of this little doldrums, and we were hoping to get back to the Bollinger Band mean and then to the fair value all the way back up here, which we thought. And in that time, it's gone from 415 to 365. That's 10 days worth of pain. Pushing Z3 to new boundaries. The 3-day shows the accelerated to the downside. You got to have a stop around 365. Stalking the rebound or getting ready to pile on to the downside for tactical trading. We've already seen, have we seen the day? Yeah, we already covered the daily. This is how good that ETF2 system and BMR system that uses the 4-month moving average as the signal of when to be invested and when to be exposed. It's been that way for months. I want you to notice just how important trailing stops are. Energy, which has been the no-brainer, and utilities, which have been the no-brainer, got murdered this week, along with materials and Latin America. So the trailing stops that are invoked in the ETF2 system and in the blended monthly rebalancing for core, it's pretty good. The core does a great job of keeping you out of it when things are bad, but the trailing stop prevents you from getting slaughtered. About the only things that are showing any kind of remaining strength, the blended commodities, DBC, and then food. China's trying to make a little rebound here, but nothing else. Well, this was just a week from hell. In the Dow 30, only 2 symbols above their 4-month moving average. And Chevron is emblematic of what happened in the industrial and energy sectors. Where's my Caterpillar. Yeah. No rest for the wicked. Everything just got brutalized. That's good for intraday trading. Past performance. Remember, these numbers are reflective, even with this much of a loss. That's how much those things are up over 6 months and 3 months. So there was no, that was no protection. And then this whole section here, all energy also. There's your blended commodities. There's your food. Yeah, not much else to choose from. China, again, just showing some surprising strength. That may be some tactical trading possibilities in there. All the U.S. below average, only oil and commodities above. Blended commodities and oil showing the strength, and only the energy sector not getting murdered. Same thing all the way across. Here we're looking at the ATR percentage to just identify our primo trading opportunities among the ETFs that are both liquid and volatile. So energy, semis, biotech, and oil and gas exploration, Brazil, gold miners. The Qs are pretty close, but not quite. What I like to do on this one is I've already seen the ones that were big winners. So I like to come down and inspect the bottom feeders here. And see what we have down here. Home builder. These are things that have been just beaten down so much. You wonder, hey, are we going to stop building homes in America? No. But the rise in interest rates means this pain and suffering is not quite over yet. But biotech feels like that's overdone. And then all of the growth and tech has been slaughtered. So I'd just like to know which ones are abnormally being punished. And the reason is that when I look at performance on some kind of stack from max to min on any time frame, and I find the average and then plus or minus one standard deviation for the normal. I like looking at the very top performers and the bottom performers as the abnormal ones to say, hey, that momentum that took them to the top, that may continue, or it may revert to the mean. So you're going to get a large move in either scenario. And then the ones that have been slaughtered, well, they're either going to continue to collapse momentum, or it's going to reverse back to the mean when people come in to buy quality on value. Like, I think we're going to keep building houses, just maybe not for the next year. So it is from these abnormal locations that the bigger moves in either direction occur. This is also the same kind of principle that you see in the sniper. And we're looking at multiple stacks of oversold conditions for Godzilla down at the bottom of the range. And at the top of the things that are in the top of their range is where we're looking at like the fireworks for continued gains, right? So that is sort of a fractal management approach. Let's go to the daily. We're going to come back to the sniper trade of the day. Let's just do that while we're here. This one was, what was this? Microsoft. It was on our radar because it was a tech leader. Here, this was the opening. Belly of the dragon. It gapped up, went through the PSAR, moved a standard risk box above the dragon. So just hold my nose and buy it. Begins to peter out, take like a 2-bar low, get filled here. If that's 1, that's 1 and 2. It rolls over, breaks through the dragon, hits the PSAR dots. So I'm short and I'm targeting back down to here. And that's right where it went. This is the supported fall crossing. So you get short there at the PSAR flip, standard risk box of $1.04, bottoms out, half a risk box off the bottom, catch it at the edge of the dragon, just take that trade. That's about 1. So if that's 2, and this is 1, we're at 3. Now we get there's support right where the dragon was, higher support, caught a 2, good dog. Crosses the dragon, hits the PSAR, standard risk box, +1. Crosses the dragon. It's so close to the PSAR, I want to see if that's going to act as support as it starts to fail through the PSAR. I take it short. This is a COTA 2 to the downside. Let me show you why. You have a lower highs crossing. My target's going to be down here. So as this starts to fail, short with a standard risk box, it immediately reverses. So I take half a box of loss. So minus 0.5. Now we have a support and a support that makes this a COTA 2, standard entry, 1 unit of standard risk, makes this move, comes back through the dragon, exit, +1. All right, so sniper trade of the day. Okay, we've already seen that one. Is now moving down into risk off. Cisco and McDonald's, still got Alcoa, Chevron and ExxonMobil in the energy sector, Intel getting weak, oil exploration, energy, Brazil for Max Pains. Tons of auto framers to choose from. Buyer's market, tons of auto framers. Yeah, so this is sorted in order of descending reward to risk. And that means they are how many daily ranges they are from the 10-day high. So if we looked at the example of Brazil, it's at 8.9% reward to risk. So what that means is if this was the 10-day high in Brazil, and this was today's range, today's little doji, that's one daily range, or today's daily range. There's 8.9 of those for it to get back to the 10-day high. That ratio is important because this thing has sold off so far that if we frame this in the usual way with a mechanical entry above and a mechanical stop below, and we just frame this ready to go, and we treat this range as the yellow zone where we don't have a directional indication yet. If that thing opens here and then breaks out to the upside, we can buy it here with a stop here with one daily range of risk, knowing that we have almost a 9-to-1 reward to risk ratio. Now, if this fails, then the argument for the downside trade is simply that this is the worst performing stock and ETF in that whole stack. Out of that whole stack of the usual suspects, Brazil is in the worst shape. So if it fails, we wouldn't be surprised if it continued to fail. So the downside, the collapsing dragon, is easiest to believe in, especially in a bull normal condition. So all of the symbols on this stack, the top 10 or 20, are really interesting. And here's my usual suspects: Brazil, Cliff, Materials, the S&P itself, the Russell, Alcoa, plenty of ideas. And then this is all the mechanical framing data for mechanical entries, the size of the daily risk box, the 10-day high, etc. Okay. So just a quick review of what's available there. The daily squeeze, on the other hand, is simply computing today's range compared to the average range of the last 30 days. So if the average range of the last 30 days looked like this, and today's range was a tiny one, then we would say, oh, that is compressed like a coiled spring. And so if we got a breakout from a standard framing, opens here and breaks out, hey, that thing could go. And then if we found the low of the day and added a range stat to it, to the upside, we can now forecast, hey, that's the max reasonable intraday move. I can now compute my risk. And now in this case, Tesla, if you look at today's daily range, there's 2.7 of those to the upside if it breaks out of today's high. So that's nice to know. And we notice that the range stat in Tesla is $64. Woo. And that's the only one that is compressed to such a degree that that just a range stat breakout gives you that large multiple. I like the fact that Alcoa is in my top 10 though, as is the Russell and is Cliff. I like that. I added this one back in just as a reminder for the snipers among us that the radar screen that we're using to generate targets uses a combination of location and short-term volatility. Location as a rational analysis of where it is on the long-term, mid-term, and short-term trading ranges. And we're looking for extremely overbought or oversold, or so precisely in the middle that a breakout from here to the top or the bottom of the range gives us a 3-to-1 reward to risk ratio. And then, as I showed before, breakouts from things that are already great could be great, or it could just be a reversion to the mean. So these extreme locations are the ones that are the most interesting. And as a result of that, we've identified some standard criteria of locations and volatility to find characteristically large movers. And our favorite one, of course, being Godzilla. He's enraged, coming up from the deep. So he's oversold long-term, oversold mid-term. We'll take any extreme, either extremely loud or extremely quiet. In this case, he's already crushing Tokyo under his feet. He's already enraged. This one, where he's at the bottom of the range, he's ready to run down the mountainside and crush Tokyo. But we really love to see that he's volatile on the 5-day. So we're comparing the 5-day volatility to the last 30 sets of 5-day ranges. And we want to concentrate on ones that are extremely volatile or extremely quiet, because these two abnormal locations, we don't really care so much about the normal. We want to find conditions of abnormal emotionality. This is tremendous amount of fear and greed. This is so quiet that it's going to be surprised. So we like abnormal volatility and we like extreme locations. When you add those together, you get compounded critical states. And that's the secret of target selection in the sniper. That's getting the right target. The rest of it is standard sniper techniques for shooting a moving target. So standard work for these abnormal targets. That's the combination. Lots of Godzillas in the S&P 500. Here's the where, so 0.11 means it's in the top of, if it was at the top of its 150-day range, it would be 1.0. If it was absolutely the bottom, it'd be 0. This one is at 0.11. So you know he's in the bottom 11% on the weekly, bottom 5% on the daily. And look at, he's in the bottom 6% on the 10-day. And he's got a 4 sigma 5-day volatility. This thing is running amok. That's some Godzilla for you right there, buddy. And this one is sorted now by 5-day volatility and declining. And then in our tactical symbol set, same thing. You can see we got materials, lumber, a bunch of the cryptos with extreme volatility and extremely oversold in every time frame. So when that many symbols are in Godzilla, and when you see big broad market indexes are in that tells you that the market itself is very vulnerable. There's tech, Real estate getting smashed because of the interest rate increase by the Fed is killing the mortgage market. There's Cliff, Tesla. So this is a target-rich environment. Microsoft, Alcoa. I can make a living off of that. There were no fireworks, meaning, so the fireworks is kind of opposite of Godzilla. These are the ones that are at the top of their stack on the short and long term or midterm. And they are very volatile. They're the explosion, and are ready to keep going or to fall to earth. So you're going to get an extreme move. But there were none in that condition. And there was only a couple fence sitters from today. These are the ones that are within that 50-yard line, plus or minus 10%. And then we're looking for a breakout up or breakout down to the extreme of the trading range. But only two in the S&P 500 were like that. This one is where I go fishing for other ideas. Like these are the 5 standard targets, but I've got other ones in mind. And as I start scanning through here, I'm coming up with more ideas of how to create more standard plays. So this is still early days. But this one is just a ranking of the S&P 500 on the basis of the 5-day Z-score of volatility in descending order. So A is the quietest on a relative basis in the entire S&P. Microsoft, Simon Property Group are in that stack of interest. This is the absence of fear about Microsoft. That's sort of like that may be the risk-free rate of return. The most volatile, on the other hand, are the ones that are blowing up. So like ConocoPhillips, 3.82. Again, this is by the Z-score, but sorted by highest. So I use these two because I'm still looking for ways to code standard plays. More to follow. That's a refinement for second generation advanced master sniper, I suppose we call it. But it turns out that you get so many opportunities with Godzilla and fireworks that you're good to go. This is the standard tactical set. I have it sorted by percent change because we're in bear volatile. And so I like to see the ones that got smashed because I think those are the ones that are most likely to continue to fail. And I also like to see the extreme gainers. And we've already seen that chart once already. Mostly winter in the 4 seasons. And then this one just gives you the extract of the sniper set for the tactical symbols, which is both of these moved over into, this is the ones that I look at on my, I'm always prepared to trade any of those. And I have these sorted by the 5-day volatility because to me, that's the most important measure of tomorrow's nervousness or excitability, is that if it's already extremely noisy, then it's already in play. Energy, Exxon, or energy, oil exploration plus Devon Energy. Look at those 5-day volatility, more than 3 sigma. That's extraordinary. Yeah, XOP and XLE are something else. Well, you saw that already in the move for in the blended monthly rebalancing, how much they'd lost on a 1 week, 1 month basis. This one is telling you everything you also need to know. The multi time frame NDX, all these reds. That's just how bad it is. Treasuries and Mexico, the few the two lone survivors today. Over in the stocks, it's Merck, American Express, and Boeing. Otherwise, everything else just getting slaughtered. Like you needed to be told that. Crucial doji at the bottom of a large 10-day sell-off. Is it going to break to the upside? Or is it going to break to the downside? Big move in either direction. There were just a handful of trading trader trades today. So before we get into the pain and suffering of sniper trading, let's go ahead and look at our traders today. Some really good work done. Arch, 6.7 today, much more relaxed. He feels the downward pressure. There's your collapsing dragon. The Z3 pinch expands right here into the Z3 expanding. So he gets that, gets paid. There's the PSAR flip, maybe 1 bar late, but he gets paid. PSAR flip, waits a bar, gets paid. PSAR flip, tries it, quick exit, stop and reverse, smashes it. This is also a collapsing dragon off of that. Of course it would be. Now here's, if we were going to try to get more, when you see this little shelf and then it breaks, and this little shelf, when that breaks, opportunities. This is such a good exit. That's amazing. Really good work, Arch. Come a long way this week. Tim, second guessing the rule set here a little bit. Starts trading here. Now, right away, there's your PSAR flip box. I want you to draw that box. If you're in the sound of my voice, draw that box every place you see those PSAR flips happening. And then realize that that's sort of the opportunity to the long side. That's not going to lose money. You know, there, you could even decide to take that long right there. And then with your stop, just use this as the risk box for 1.0, and then just decide I'm going to use the bottom of the dragon as my execution. So you're really limiting your loss already to just a 0.5. And that's still a good signal. By the same token, you have this standard risk box here. And there's the PSAR break. So you should be short right there. And then if you take this risk box and hang it over there, it probably looks something like this. And then all you do is you just decide, look, I'm going to take the top of the dragon and limit my loss on that one. So I'm never going to take a 1.0 loss. I'm never going to take a 1.0 loss. At most, I'm going to take about a 0.6 if this reverses up. And then meanwhile, you have this whole thing, which you probably want to do a 1, 2, 3 exit, and exit right there. And then you have that trade. Now, by the same token, this one, here's your PSAR flip box. There's your signal to get long. If I take my standard risk box and bring it over here, it probably looks like about there. And then I just am going to limit my loss to the bottom of the dragon. So I've only got about a 0.7 that I'm going to lose. You're not going to lose money on this trade. You should when this breaks across the VWAP and then rolls over right away, I'd exit right there. Your next one short is here. That's correct. Now, 1, 2, 3, we should be getting out here. I wouldn't even be offended if you got out right there, but you limited that to a 0.7. That's fine. Perfect. Oh, no, I like this. Now, when this short immediately fails and this short starts immediately failing, don't wait for a 1.0 because that's giving you a low, a higher low, a higher low. That's feeling like a kata 2. So if it doesn't work right away, just get out of it. And then your entry here on the upside is perfect. Got paid. And then this one probably right here, that's still pretty good. And then that would scratch. So between this one and this one, we could be like +3 today. So respect those PSAR dots, frame those trades in both directions, limit your loss with the use of the turning points in the dragon when he's there. And that way you'll further limit your losses and really just relax. But good work there. We already looked at Paul. Now, I took Nicole's and I did what I told you I want you to do, which means I actually want you to do it. Notice all I've done is I've added that big thick box wherever the PSARs flip. And then notice that the size of that standard flip box is really equal to your MMRB. So now what I'm going to look at is what is the templated ideal entry. On this one, it's right here when it takes out the PSAR flip as opposed to here. So if you got this one long and you were this far, you're almost +1 in hand and it starts rolling over, I wouldn't be offended if you wanted to get paid. Wouldn't be offended. And you never would have re-entered. And now you get the next PSAR flip. Now, where this one exited is where you should be entering as opposed to here. This is the difference that your waiting around made, which was almost half an hour. So not hitting your mark cost you half an hour there. Now, if you get short here, this thing comes down to here, I'd be getting out here instead of letting it come all the way up, all the way down, and then up, and then getting out here. So I don't want to take that extra pain and suffering right there. What I want to do is get this one short where I'm supposed to. 1, 2, 3, cash that trade. Now it rolls over. It can't even get to the PSAR. So now I could either get short here or where maybe better was where this RL10 rolls over and leaves the dragon. I love that as the short. Yeah. So you got short there. Now this rolls over, it came down and back up. If you take that as your exit in order to get paid a little bit, then you got to immediately get short here. The resumption of the trade. And then you get all of that. And now on this far of an excursion, I'd probably want to get out here at the edge of the dragon instead of waiting for the PSAR. Now, here's where the next PSAR flip hits right here. And so the long position, that's still pretty good. That's pretty accurate. And that's good all the way. And you decided to get paid. Love it. So we just got some work to do in here, getting short here. And then we got to hit the reentry there. Not bad. Draw those on all your charts from now on. Draw those black boxes where the PSAR flips hit, so you can see where your entries are occurring compared to the optimal entries or the theoretical entries, the doctrinal entries. My brother. Now notice so he's in a downward trend. PSAR tells you that. Dragon tells you that. The RL10 kind of flattened out and started to roll over again and south of the dragon, so instantly shorts. Gets a second one on because why not? He's got 1.5 hour in hand. And then it bottoms out and starts coming up. And where the RL10 crosses the baby dragon, he covers for 3.7. Sweet. Now, here's where the PSAR flip box is. Notice that if you start off with that, you're never threatened. I think I'd be looking at this exit, trying to be like over here or maybe on this one. But that there's not much to choose from between those two entries. This is fine. The reason I like that one, even if you don't take this one, you still got to take that one, because now notice what the RL10 does. Comes up, holds support at the edge of the dragon, and starts to resume. That's caught a 2 all day. 4.5. Nice work. This is Jack. 6.25 today. All right, so I can relax. There's his supported fall crossing, properly short. Tries a second one, quick exit, well done. Looked at re-entering here, probably would have scratched. Got the all-important re-entry here. Tried a second position right away. Quick. And then I think because of the cognitive effort of getting 2 positions on, you were mentally tired. Yeah, you weren't psychologically correct because you were giving up R on not 2 stupid second positions. They were ventures. You didn't give back much, but that made you mentally tired, and you missed this, and you missed this, and you missed this. This is why I say, until you got 1,000 trades under your belt, don't mess with the second position. Trade one position properly. This is a good SSC. As soon as this fails through the dragon, just get out. And now you can be short here as you were. And there just wasn't much in it. Now it has reversed. Here's the Z3 pinch. Caught a 2, paid, tried short, quick reverse. Caught a 2 should be here. Got paid. Got short, quick scratch. Didn't even hit the PSAR, so he stayed with it. Got paid. 6.25. And that's on the Dow. That's on DIA. big, slow moving tugboat. This is some currency. Correct. Caught a 2. Correct. Good short. I think we just saw those. Yeah. Oh, this was the afternoon trade in here. Got paid. Good scratch. Good scratch. Scratching all over. It's starting to get tired. Stayed with it. Got paid. 6.2 for the on that segment. Pretty good. Getting a lot of reps in. On a week where the market got slaughtered, Woj just quietly brought home 18R for today. Making sawdust. He saw that beginning to fail twice. Got the one that confirmed. He was waiting to see that. I don't disagree. Got paid, got paid, got paid. Missed a re-entry, but still got it. Could have been a little better, but that's still pretty good. That was worth a shot. But you killed the one that mattered, and I'm wondering, where were you? That's enough for the end of the week? Really? Okay. Working on this, but notice that when he started adding some of these other ones to start working on, that he got a lot calmer on the other ones. Here's his crossing the dragon, PSAR flip, wrist box, 5R. Good scratch. Rolls through, short, wrist box, 2.5R. That's 7.5 more. There's gold in there. I'm telling you guys. This workshop's going to be $3,000. So pay attention now. All right. Sniper trades of the day. Buckle up. All right. So this was Microsoft, and we saw this one once already, but so I'm going to go through that pretty quick. Gap up, rocket ship up, get paid, get short, standard work, hitting the PSAR, standard risk, caught a 2 to the downside, get paid at the edge of the dragon. SSC, or actually this is a caught a 2 because support, higher support, standard risk. Get paid, get short, quick scratch, SSC, get paid. Microsoft. This is Mexico. This is the open right here. I'm noticing the PSAR declining and it's trying to go north. So I'm either going to get short down around here or long somewhere up around here. And that's about 25 cents between those two lines. And this is the 25-cent risk box. PSAR flip crosses to the upside, SSC. get paid, crosses, dragon rolls over, supported fall crossing, standard risk, standard exit, standard entry. Not going to lose money on that trade because by this time, I'm going to get your risk out of here. Get that risk out of here. Check or hold. Alcoa, because of reasons. So there's my standard risk box. I would execute off the bottom of the dragon. It failed pretty quick. So just get no lose plus dinner for 2. Breaks through to the downside, supported fall crossing or collapsing dragon. Hits the PSAR, standard risk. I should be right about here by now. From here. Check or hold. I mean, you can feel that when that thing starts to not fail further, you can just feel that happening. Look how the RL10, if the RL10, if that thing was failing, that RL10 should look just like that. It didn't. It looked like this. That's how you know. So when it crosses the top of the dragon, you just get out. You don't even got, and now you can think about getting long, probably somewhere over in here. Or short when it fails. And now you get see how that RL10 rolled over? I could even have my stop right there, like about 0.3 of a risk box. Dude, I'm not going to lose money on that trade. I should be right there. Pretty good. So that's Alcoa. That gets paid probably 2R. I'm going to save that one. Help Peak, our old friend. This came out of nowhere. Had never even heard of these guys until Godzilla said alert. Standard risk. It opened at an immediate PSAR flip, moved a risk box off the bottom of the dragon, broke through the PSAR. Put your execution risk like probably right there for about a 0.7 risk. No brainer. What would we call that entry? Supported fall crossing. No brainer. That's about 3.5R between those two trades. What would you call that entry? Besides obvious. Hey, this thing found, look where this thing found support. You're not even allowed to be surprised that it found support there. SSC. No brainer. 5R. ARE, the other healthcare real estate. There's the opening at the blue box, or at the blue line, excuse me. I want you to notice the feel of a kata 2 on this one. This is on 5-minute chart, so. Support. Zoom. Starts to roll. That's what price did. But the RL10 never even looked back. And from the bottom of the dragon, it moved one standard risk box off the support at the dragon. So this is like a why not entry. Because all I got to do, I mean, all I got to do is get my stop from here to here so that I can lock that in. And then I don't care. Why not? Take your pick. Standard exit, check or hold. Short when it hits the PSAR. Standard risk box to the top of the dragon. Standard exit. It found support here and support here. Not surprising. The last time it found support here, it did that. When this PSAR comes down and price goes through here, could it do this and get to here? Could. I don't know if it does. We'll see. Yeah, it could do that. How good is that? I mean, how good is that? One unit of risk. And look at the symmetry. So that's about +1. That's about +1. That's about +1.5. So that's about 3. Cleveland Cliffs. Let's see. Gapped up and moved up. Tried it. Rolled over. Scratch. Check or hold. Do I believe in it? No, I don't believe in it. Not at all. Why would I do that? So just re-enter it again. It didn't fail further. Standard risk. Check or hold. Same crap. Hit the PSAR. There's the PSAR flip. There's the standard risk box. where would I draw my execution line for getting out of this thing? So this line would represent minus 1.0, right? For my entry here. So that's my standard risk box, 1.0. Where would I draw my actual execution risk on this one? Top of the dragon. So that's about 0.6 and 0.4. So I'm limiting my risk to just this. Just one way that I can take some of my risk, get my risk out of here. Where would you estimate a reasonable downside target for this thing? Or the low of the day, but it's really this one. Because if it fails through there, look out below. Standard exit. Didn't really fail enough. So if that's 1R and it gets to here, almost 2. What would you call that entry? What would you call that size of that risk? Standard risk. That's the R10. Get paid a half. So I set my risk to here. This is the 1.0, but I'm getting long here and I see the belly of the dragon. I would just put it right there. That's about half. And then right around in somewhere around in here, I want to get this up to right there so that I can just lock in my little fraction. And then you can suffer about where to put your stop. As long I want to get you to here where you have a good problem. Oh, but there's more. Rivian, the not Tesla, at $25 a share. Let's see. Opens, ran up, couldn't make it further. Downward looking channel. What would you call that? Target here. You can think about adding a second one there as a CD. This is probably SFC. Standard work. If that's 1, 1, 2, 3. Devon Energy. This is the third day in a row for Devon Energy. And Energy got smashed today. Collapsing Dragon. Get paid 1R. Re-entry short on a rejection of the PSAR. Standard exit. One, 2, 3, 4. There's your signal to get out. But there's more. Okay, so that was Devon on the 5-minute. If you're trading Devon on the 3-minute, it's the same trade. If you're trading Devon on the 1-minute, and you got an extremely tight risk box in there. Oh, look at Devon Energy on the 1-minute. Holy smokes. I mean, geez. And this one makes it abundantly clear where your second position ought to be, where your third position ought to be, a fourth position if you want, before it ever even hits the PSAR. And even that one paid off on an SSC on 1 minute. So I just wanted to show you the difference of what that move looks like in one trade over 3 different time frames. Oh, but there's more. So ConocoPhillips. There's your CD. Here's your opening. Standard risk box. That's the R10. Second position on the collapsing dragon. And remember, this is on 3 minutes, so it's very manageable. Notice that little 1, 2, 3. Second position. This one doesn't even hardly get higher, so you get a third position. Standard exit. Standard re-entry south. Another 2R. So just to do a little math, 60-cent risk box. So you're short at about 101 and you exit at about 95-ish, 95.5. So that's 5.5 on the first one. From 99 to 95 is 4 on the second one. Third one is from 96.5 to 95 is about 1.5. So that's 10, 11. That's 11 divided by 0.6 plus 2, 20R. ConocoPhillips. So that's about a 40R day if you were going through all that sniper. My brother makes a note. Could I elaborate on fractal natures? Yeah. The idea of a fractal is that you have some kind of pattern. There's just some kind of pattern. And that pattern repeats in every time frame. If you ever want to just have some fun and hypnotize yourself, go look on YouTube called the Mandelbrot set. Famous mathematician who found a mathematical formula that when you run it, you got a constant, and when you graph it, you get the most amazing, beautiful visuals you've ever seen. But the idea being is that if I see some kind of standard pattern, and then I zoom in on some little portion of that time frame and expand it out, I can drill down and see the same thing happening. And then if I drill down here, I can see the same thing happening. So fractal patterns means that you get reinforcing moves. One of the nice ways to look at this is in the sniper. Is that we're looking at 150-day look back. And we're seeing that thing is in the bottom of his trading range. Okay. And so that when it's in the bottom of his trading range on 150 days, I don't know how it, what the pattern was that got him there, but I know that right now he's down in this. And so maybe he went like this, something like that. And so you mark that off as the high, that's the 100. And this is the low was 0. And so as long as he's under 10. Now if I could look inside the head of a guy who used the last 150 days to pay attention to what was going on, the long-term swing trader or position trader, he is in maximum fear. Because if this thing fails just a little bit more, that's going to trigger him into action. And that action will be panic sell. So as this thing weasels its way down here, if that line gets violated, like on a collapsing dragon, then the guy who has trading on weekly charts or long-term position, who's just watched his thing go from there to there, he's going to be pushing the panic button and be motivated to sell. Now, if I just when I start thinking about fractals, if I go back just 130 days or 30 days, excuse me. And now I bring that guy, I look at this and I say, well, the top 10% is greed. The bottom 10% is fear. So when this guy is, he's oversold now, he's near the bottom of his 30-day range. This 30-day look back person is in exactly the same mindset as the 150-day, that as soon as it breaks below this price level, this guy's in a panic. He's reaching for the panic button to sell. So now I've got two different populations of people, a short-term swing trader and a long-term position trader, who both happen to see the same setup, that in their look back period of interest, they are right on the boundary of fearful action and panic. They feel fear and are ready to panic. That's where they are. Now, if I look back at the 10-day period and I see the same thing, oops, sorry, that should be red. This guy up here is feeling greed, and this guy is feeling fear. And he sees his prices in his bottom 10%, and he knows that if it breaks through that line, his fear is going to instantly turn to panic. All right. So now this is what we mean by fractal. What I have is three different time frames. I have the 150-day look back period in population. I have the 30-day look back period in population, and I have the 10-day look back period in population. And it turns out that all of them are stacked up rationally. They are in fear, and they are a short trigger. All it takes is one more straw to break the camel's back, and they are going to push the panic button. They are ready. As soon as price leaves fear and breaks through that little collapsing dragon boundary, these guys are going to race and push the panic button. So that's with their rational mind. This is just based on location. Now let's take a look at volatility. Short term. This is about emotion, emotional action already in play. And this is rational. This is like a rational fear. I have a reason to be afraid. Volatility means I am afraid, and I'm getting scared. Right. So when the 5-day range is very large, 1, 2, 3, 4, 5, this is large volatility. Then all these guys that were fearful over here, they can see the reason why they were afraid. So one more little tipping point, and that trigger is hit. And they run over and hit the panic button. Now, the 1-day volatility, what if the 1 day, though, was this tiny little doji? Hey, these guys sold off hard for 4 days, and then the 5th day, it held. It did not fail further. It could be that that's the turning point that's going to give you the SSC. It might work, but you know that if that triggers, then the emotional anxiety of this is going to blow right through that doji, which was just a a pause, and then it's going to collapse big time and invoke all of that panic and fear. But that little doji at the end of a 5-day sell-off is a fractal pattern that says maybe that's the pivot point, or maybe it's just going to continue, but I can put a tiny risk box around that and be ready to go in either direction. By the same token, the inverse fractal pattern is, what if the 5-day range yesterday, that terminated yesterday, was very small? So 5-day volatility was very small, but today's 1-day volatility was very large. What does that tell me? Oh, that coiled spring, that super pinch, or that Z3 pinch, which I framed just broke out to the upside, and I got 1 day of massive volatility to the upside. Guess who that is going to draw? Everybody that was over here that was, oh man, let's come look, let's get some more of that before it runs away. So there is a fractal nature to the location, looking at multiple time frames. And when they're all, those fractals all overlap, the collapse leads to panic. And then large volatility that terminates in small volatility, 4 huge days down, and then 1 small day of recovery. That could be either this or that. Or 4 days of very quiet volatility, and then 1 large day says maybe this is a breakout, or maybe that's a false breakout and it falls back. Either way, those 2 fractal patterns are looking at standard patterns over multiple time frames that stack up. When you can stack up location plus volatility, you get compounded critical state. And that's the one that is the most likely to have huge moves in either direction. So to summarize then, fractal patterns are standard psychological plays that you see human psychology operating in that time frame. So a standard would be rising lows. What would we call this pattern? If I were buying these in those little places right there, do we have a name for that? Yeah, kata 2. As long as that kata 2 is working, I'm going to keep working. So when you see a pattern like this, when you try to make sense of that, you say, what's going on? And you're seeing people that are willing to buy strength on a dip, because I'm buying something that's very strong, but at a better price here than chasing it back there. I feel it came back and now I buy it. And that buying action is what continues to drive it up. So as long as there are people with that mentality, this little pattern will keep working. And every successful trade reinforces the belief that buying strength on a dip is a good idea. Oh, what would you call this pattern? Now be careful. These are all CDs, right? Because what I did was I was waiting to see that broken, and now I'm piling on here. So every one of these in red is a CD, a violation of a previous support level. Now, why is that powerful? Well, because the last time it was here, it didn't fail. In fact, it found support and went up. So by waiting for the CD to occur, what I'm really doing is looking for confirmation that that support level is no longer support. Support just broke. And then whatever this downward move was is implying that move, check or hold. Now, because the downside move is so powerful, and if we've seen one or two of those things happen already, we might be tempted to play this move in purple. And the idea would be, I've seen a high, a lower high. Now the purple, what pattern would we call that? Kata 2. So in this case, the Kata 2 is front running the CD. Do you see that? The Kata 2 gets in just a little bit before the CD. Then when the CD breaks, the signal hits, everybody that wants to play the support, the breaking of support, is trying to get their entry in while you're simply getting your move, your position to no lose. So the Kata 2 is a little bit of a front run on every one of these little CDs. We call that the pocket. That little, this little triangle in here between the peak of the emerging dragon and the belly of the RL10, we call that the pocket. And that's where the Kata 2 is entering. But there's nothing wrong with waiting for the CD to confirm. It's just as you start seeing this thing continuing to fail, sometimes the Kata 2 gets you in that little bit extra, and you're not waiting for the extra confirmation. Now, that pattern is the opposite of buying strength on dips. What I'm doing is I'm getting short on weakness, check or hold, short on weakness. Now, the fractal nature of this thing. Now, imagine that on a daily chart, I saw this. Doji. I might be able to do, let's see, where's mine? There it is. I might say Kata 2, anyone? Does that look like a Kata 2? And if it breaks out, I'm long and I'm buying strength on a dip. Now, if I take that next daily range and now I expand that to hourly charts, maybe I see it open Here's where the market opens. And it opens right here, goes up, comes down, goes here. And then I see this, then this. Doji comes down, doji, doji, higher doji. Now the hourly bars are showing me something like the same kind of fractal pattern. The same idea that I got a low, higher low, higher lows. So inside that day, I might be able to see that same kind of kata 2 formation, which indicates that the buyers are stronger than the sellers because they keep coming in and they're willing to pay more and more. And it's making higher highs. So I have reason to believe that there's an upward channel. Well, if that's what it looks like on an hourly chart, that's the same thing that's happening intraday as was happening on daily charts. So the guys on daily time frames are buying the dip. The guys intraday are buying the dip. What if I took that little hourly bar and I put that on a 5-minute chart? And I see something like this. Now on the 5-minute chart, I see, oh, well, there's a low, a higher low. And I want to get in. Maybe I want to get in here because I know that if it takes out this little piece here, that thing's really going to go. So maybe I can just buy it on this kata 2 instead of waiting for the emerging dragon. So now what I've done is I've taken the same idea of strong pullback, buying the dip on a daily. I've seen the same pattern on the hourly, and now I see the same pattern on a 5-minute. And now I have all of those technical reasons wanting to push this thing north. So when we talk about fractal patterns in trading, what we're really trying to do is say that guys from different time frames, their brains are all wired the same way for fear and greed and pattern recognition. It's just that the time cycle, the time cycle from start to finish of their decision cycle is working. It could be daily, it could be hourly, could be 5 minutes, it could be 1 minute, it could be weekly, but the same kind of patterns that trigger that buy on dip or sell short the weakness, or super quiet pinch, be ready to trade it in either direction. Those are kind of the 3 patterns that there are, aren't there? Or there's another one where it's a wide channel and you're playing this. Like we saw a lot of that today, buying oscillating inside a channel. So all of those patterns are standard. What makes them fractal is when they are stacked up and working on different time frames. So that's what we mean by fractal patterns. Check or hold. All right, that's enough for tonight.